I nearly dropped my phone when I saw it. A tweet so bold, so shocking, that I couldn't believe it at first. But then I dug deeper, and what I uncovered left me staring at my screen with goosebumps running up my arms. Because if this rumor is true, XRP might be sitting on the edge of a supply shock so massive it could rewrite the entire playbook for this coin. And if you're holding XRP even just a little, this is the kind of moment you'll look back on and say that was the turning point. This is not financial advice. Now, before I dive into this story, let me quickly say this. If you want to see exactly how all the pieces connect, the documents, the infographics, and the videos that break it all down step by step, I put together something special called the XRP Millionaire Blueprint. It's all laid out for you in a clear, structured way, and the link is in the pinned comment below this video. Go check it out because it'll give you the full picture in a way that's easy to follow. All right, back to the story. So, there I was scrolling through X, the Bird app, and suddenly a familiar name in the XRP community jumps out at me. Ripple Van Winkle, and he's basically shouting that the XRP supply isn't what people think, that most of it is already spoken for, that retail investors like you and me are only scrambling over scraps while the big players are hoarding the feast. Then he started dropping numbers, hard numbers, and that's when I knew I had to dig in. See, Ripple itself has locked up around 35.3 billion XRP in escrow. That's not some random rumor. That's right there in their reports. Add another 3.5 billion XRP Ripple holds outright in their own wallets, and then you've got the founders, Chris Elson, around 2.3 billion. Arthur Brito, another 1.3 billion. So right there, over 42 billion XRP is locked up tight in strong hands. That's over 40% of the supply basically removed from circulation. And here's where it gets crazy. Analysts are saying that when you add up retail, institutions, and exchanges, the slice of XRP that's actually liquid, actually moving around, is much smaller than anyone realizes. Some estimates say retail investors might only control 15% of the supply. 15%. Out of 100 billion, that's just 15 billion XRP in the hands of everyday holders like us. Now pause and think about that. You're at a pizza party. You walk in thinking there are 8 slices for you and your friends. But actually, 4 slices were eaten before you even got there. And the rest of the party is now fighting over what's left. That's XRP right now. Everyone thought there was plenty. But when you factor in Ripple's stash, the founders' bags, and now institutions starting to nibble, suddenly the leftovers look very thin, and institutions are nibbling. Purpose Investments, a Canadian fund, holds about 29.6 million XRP. 3iIQ, another asset manager, holds 45 million. Now, that might sound small compared to billions, but these are just early players. Think about what happens when the giants, BlackRock, CK, Fidelity, JP Morgan step in once XRP spot ETFs go live. They don't nibble, they feast. And speaking of ETFs, let's just take a second here. Spot ETFs are the golden ticket for mainstream adoption. They make it easy for trillions of dollars in institutional wealth to flow into XRP through regular brokerage accounts. No wallet setup, no exchange signups, just click buy like they would Apple or Tesla stock. And the timing couldn't be sharper. October is being circled as the month we could see the first spot XRP ETFs. If that happens, we're looking at a tidal wave of demand slamming into a shrinking pool of supply. Now, here's where the story takes a jaw-dropping turn. Exchange reserves. If you really want to see whether a coin is becoming scarce, you check the exchange wallets. And when I saw what happened on Coinbase, I had to triple-check that I wasn't reading it wrong. In June, Coinbase had 52 different XRP cold wallets holding a combined 970 million XRP. Nearly a billion tokens just sitting there. Fast forward to September 20th, 2 wallets left, just 32 million XRP combined. And now reports are saying even those are empty. Coinbase's XRP cold storage is effectively drained from nearly a billion XRP to zero in a matter of months. Now think about that. Exchanges are like the grocery store shelves. When they're stocked, no one panics. But when the shelves start going bare, that's when people rush in and start grabbing what's left. And with XRP, those shelves are looking emptier by the day. And it doesn't stop there. New projects like Flare Network with FXRP and Axel with MXRP are literally designed to lock up XRP on purpose. To use those wrapped versions, you have to deposit real XRP as collateral. Once it's locked, it's off the open market. And the demand for these wrapped versions has been insane. Flare's FXRP capped their launch at 5 million XRP in the first week, and it was gone in hours. Their long-term goal locking 5 billion XRP. Combine that with Axel's plans, and we could see another 13% of supply taken off the table. Let me say that again. Between Ripple's escrow, the founders' bags, institutions nibbling, exchange reserves vanishing, and new DeFi projects swallowing supply, the amount of XRP truly available to buy is shrinking fast. And that's the moment I realized this isn't just a coin with utility partnerships or fast transactions. XRP is quietly becoming scarce. And when something scarce meets rising demand, the outcome is inevitable. The price has to adjust, sometimes violently. Now, I'm not here to throw wild numbers at you. We've all seen the crazy $500 or $1,000 predictions. What I'm saying is simple. When a trillion-dollar asset manager decides to grab XRP for their ETF, they're not fighting Ripple for those escrowed coins. They're fighting us. They're fighting retail over that tiny 15% slice. And when whales start draining the pond, it doesn't take much before the water level drops fast. And let me tell you, the water level is already dropping. XRP is in a position right now where the psychology of the market is shifting faster than most people can even process. What's happening behind the scenes with exchanges, regulators, and institutions isn't just noise. It's a deliberate restructuring of how liquidity will flow in and out of digital assets. And the key point most people miss is that XRP is being positioned as the bridge, whether retail investors like it or not. Think about this. In every bull run we've had so far, the majority of coins have relied on hype cycles, speculative inflows, and retail-driven mania. Bitcoin led, Ethereum followed, then the rest of the altcoin market trailed behind. But the narrative this cycle is fundamentally different. We are not talking about memes driving the next stage of growth. We are talking about actual structural adoption. The kind of adoption that doesn't disappear when the hype fades because it's tied directly into payments, settlements, and compliance systems that global institutions depend on every single day. And that's where XRP stands apart. This isn't about whether you like or dislike Ripple or whether you agree with their partnerships. The reality is when central banks and governments are actively testing solutions that plug into Ripplet or XRP ledger infrastructure, that's not speculation anymore. That's groundwork being laid for utility-driven demand. Now let's zoom in on the exchanges themselves because this is where the real trigger point lies. Right now, retail traders assume that as long as they can log into Binance, Coinbase, or Kraken, XRP will be sitting there with buy and sell buttons like always. But that assumption ignores how markets actually operate in a high-liquidity, institutionalized environment. Exchanges are not built to handle systemic liquidity events at scale. They are built to match retail buyers and sellers under normal volatility conditions. When the liquidity flood actually arrives, it will not be routed through public order books where you can casually pick up XRP. Instead, the majority of that flow will bypass retail entirely, moving through private liquidity corridors, institutional desks, and market makers who already have agreements in place. That's why people keep warning that one day XRP will effectively vanish from retail exchanges, not because it's being banned, but because the volume and price action will move into a different lane that retail can't access. And history has already shown us what that looks like. Every time an asset suddenly finds institutional demand, the supply available on exchanges collapses. We saw it with Bitcoin in late 2020 when PayPal, Square, and Grayscale started soaking up BTC. Supply on exchanges dropped to multi-year lows, and retail was forced to buy at higher and higher prices because there simply wasn't enough left in circulation. Now, apply that same dynamic to XRP, but amplified. Unlike Bitcoin, XRP was designed for liquidity movement. That means when banks, payment providers, or ETFs start using it in volume, the absorption rate is going to accelerate far faster than anyone is modeling. And when that happens, the exchanges will either lock down withdrawals, restrict trading, or quietly delist pairs because the supply imbalance will make normal order books unstable. Most retail investors will panic when this occurs. They'll think XRP is being removed or suppressed. In reality, what's happening is the exact opposite. The real market is shifting behind the curtain, and the public exchanges are being left with scraps. If you've been paying attention to settlement news, CBDC pilots, and liquidity hub testing, you already know this isn't a fantasy. It's the logical next step. Now let's talk about psychology for a second. In every bull run, 90% of participants underestimate how fast things move. When Bitcoin goes from 10,000 to 40,000 in a matter of weeks, people convince themselves it's too high to buy. They freeze, they hesitate, and by the time they finally commit, the move is already 80% complete. XRP is going to create an even harsher version of that reality because its liquidity shock will come not just from speculative hype, but from structural removal of supply from exchanges. That means you won't just be late, you literally won't have access. Think about the irony. For years, XRP holders have been ridiculed, mocked, and told that the flip of the switch is a myth. Yet, what's being constructed right now is essentially that switch, a migration of liquidity that will occur faster than the average investor can react to. By the time retail realizes it, the new rails will already be live. Now, if you want proof that this isn't speculation, just look at the legal and regulatory sequencing. The SEC lawsuit dragged on for years, suppressing XRP and keeping institutions at bay. But once the ruling clarified XRP as not a security for secondary sales, that was the green light. Exchanges relisted. Liquidity hubs began testing again. And ETFs, though not yet direct XRP ETFs in the US, started forming baskets that included it overseas. That sequence isn't random. It's the scaffolding being built for integration. And here's something most people miss. Once an asset becomes part of regulated ETF products, the way liquidity flows changes forever. No longer is price discovery being determined solely by traders on Binance or Bybit. Now you've got custodians, authorized participants, and creation-redemption mechanisms pulling supply directly out of circulation. That reduces volatility for institutions, but increases scarcity for retail. XRP is walking directly into that environment, and once it does, the days of cheap accumulation are over. Here's the cold truth. Most of you listening right now will not react in time. You'll overthink it. You'll wait for confirmation. You'll tell yourself you'll buy when the price dips again. But there won't be a dip in the way you imagine, because dips require supply, and supply will be locked in institutional pipes. That's why the concept of XRP vanishing from exchanges is so critical to understand. It's not fear, it's mechanics. Now let's project what happens when the switch flips. Picture this. Overnight, liquidity corridors for remittances, treasury management, and interbank settlements start running live volume through XRP. Exchanges simultaneously see order books thinning out. Withdrawal fees spike, trading pairs freeze, and then comes the headlines. XRP liquidity shortage, institutional demand surges, supply shock underway, retail will scramble. But by then the window is already closed. And this is exactly why the patient holders, the people who position themselves before the flood, will be in an entirely different reality than the ones chasing after. We've seen this story play out with every major asset class, when it transitions from speculative phase to adoption phase. The ones who were mocked for holding suddenly become the ones impossible to catch. Now, let's add one more layer to this: central bank digital currencies. Everyone keeps debating whether CBDCs will kill crypto or make it irrelevant. But in practice, CBDCs are useless without liquidity bridges. They are siloed systems unless they can interoperate. That's where XRP's design comes into play, to serve as the neutral bridge asset between digital fiat systems. And once that switch is flipped, the volume flowing through won't just be speculative trading, it will be sovereign-level money movement. At that point, the conversation around price targets changes completely. Retail investors will still be asking if XRP can hit $5, $10, or $20, while institutions are thinking in terms of trillions of settlement flows. That's the disconnect that creates exponential repricing. Because when you stop valuing XRP as a speculative coin and start valuing it as a liquidity bridge for global finance, the multiples shift into an entirely different scale. So the bottom line here is this: XRP disappearing from retail exchanges isn't a maybe. It's an inevitability once the liquidity corridors are activated at scale. The only question is whether you're positioned before or after that happens. By now, if you've been following along, you can see the story coming together. XRP isn't just another altcoin riding the wave of crypto hype. This is a structural setup: supply shrinking, liquidity corridors being readied, institutions circling like sharks in a pond that's already half dry. And what's coming next could change everything for holders who are paying attention. Let's break down the timeline. First, exchanges have already started depleting their reserves. Coinbase went from nearly 1 billion XRP in cold wallets to virtually zero in a matter of months. That alone should make anyone stop and think, if liquidity is disappearing this quickly, what happens when real institutional demand hits? The answer: extreme scarcity. Next up, spot ETFs. Right now, there's a wave of anticipation building around the launch of the first US-approved XRP spot ETFs. Unlike hybrid or futures ETFs that only track price movement, spot ETFs actually hold the asset. That means as these ETFs start gathering assets under management, millions, eventually billions of XRP are effectively removed from the open market. Retail supply shrinks, price starts to adjust to reflect real scarcity, and institutions don't buy in small amounts. They buy in the millions, sometimes tens of millions at a time. Combine that with wrapped XRP projects like MXRP and FXRP. These aren't just gimmicks. They represent deliberate token lockups. Every MXRP or FXRP minted requires actual XRP to be deposited as collateral. That's more supply out of circulation, more scarcity building silently beneath the radar. And as demand for DeFi exposure grows, these locked positions could eventually add up to another 10 to 15% of the total supply. Now, let's layer in the psychological side. XRP holders have been conditioned over the past 5 years to wait it out. Hold through SEC drama, price crashes, and exchanges delisting and relisting XRP. That patience means the market is crowded with holders who are willing to diamond hand their tokens. So when scarcity hits, the first reaction isn't selling, it's holding. That compounds the effect. Reduced supply plus committed holders equals a potent recipe for rapid price appreciation. And here's where the timeline gets really interesting. Assuming spot ETFs start flowing in late 2025, institutions have had the entire lead-up period to plan, line up custodians, and secure XRP from OTC markets. So when they move, it won't be gradual. The first wave could be violent. That's the moment when exchange order books thin out further, withdrawals spike, and retail realizes there's suddenly a serious shortage. To put this in perspective, imagine the last time Bitcoin's exchange reserves fell to multi-year lows. Price volatility spiked, FOMO dominated headlines. People scrambled to buy at higher prices because there simply wasn't enough BTC readily available. XRP could see a similar scenario but amplified because its total market cap and circulating supply are smaller. The relative impact of large institutional buys is more dramatic. Let's talk price mechanics for a moment. Most people think of price targets in a linear fashion. XRP is 2.90 now, so maybe it will be $5 next. But scarcity-driven moves are exponential, not linear. When supply is limited and demand surges, every additional buyer has to pay more to secure coins. That's not speculation. That's basic economics. The combination of exchange depletion, locked supply in DeFi, and institutional appetite creates an environment where each incremental buyer competes harder, driving price spikes faster than most retail models anticipate. And don't forget the timing of the SEC settlement and regulatory clarity. That has been the quiet catalyst that sets everything else in motion. With legal uncertainty removed, institutions no longer need to hedge regulatory risk. That opens the floodgates for mainstream adoption, corporate treasury usage, and large-scale ETF integration. Put simply, the path has been cleared, and the market is preparing to accelerate. Now it's natural to wonder, okay, so supply is shrinking and institutions might move fast, but how quickly can we actually expect the market to respond? History provides a clue. Look at the early 2021 crypto bull run. Bitcoin went from 10K to 64K in just a few months. Ethereum surged similarly. Supply bottlenecks in those cases were partially responsible. But XRP's situation is more extreme because the liquid retail portion is so small, maybe only 15% of total supply. That small float makes it far more sensitive to high-volume inflows. This brings us to another critical point, volatility. Scarcity doesn't just push prices up, it creates wild swings. Expect short-term retracements, massive spikes, and periods where XRP is barely moving on exchanges because coins are tied up in long-term positions or private institutional agreements. For holders, this can be thrilling or terrifying depending on how prepared you are for rapid swings. And let's layer in adoption-driven utility. Banks, remittance services, and cross-border payment providers are already experimenting with XRP Ledger for liquidity purposes. Every time a real-world transaction uses XRP, it strengthens the argument that demand is sustainable, not purely speculative. That kind of usage doesn't just support higher prices. It makes the market structurally tighter because more coins are held long-term for operational purposes. Then there's the DeFi angle, which is quietly building. Projects like MXRP and FXRP are just the beginning. As more protocols emerge, the amount of XRP being locked as collateral will grow. Think of it like a snowball rolling down a hill. Each new project adds weight, momentum, and scarcity to the existing supply. And unlike speculative trading, this locked XRP is often not released back into circulation for months or years, effectively removing it from the pool permanently. By now, it should be clear this isn't a single catalyst we're looking at. It's a perfect storm. Exchange depletion, institutional demand, ETF integration, DeFi locking, ongoing adoption, all converging into one massive structural squeeze. That's why you're starting to see excitement in the community and whispers about potential supply shock scenarios. And here's where the mental edge comes in. Retail investors who understand this dynamic have a huge advantage. This isn't about panic buying. It's about positioning yourself in a market that's increasingly constrained, knowing that the float is small, that institutions are planning large moves, and that demand could surge rapidly allows you to make informed decisions rather than reacting emotionally after the first major price jump. Timing is everything here. Every week leading up to potential ETF launches or major adoption announcements could see incremental changes in liquidity. Some XRP moves off exchanges into cold storage. Some is locked in DeFi projects. Institutions quietly accumulate. And the longer this prelude goes on, the more severe the eventual scarcity shock could be. Now here's an important insight that most people overlook. This isn't just about a single price spike. Supply shocks create layers of market dynamics. First, retail might see a moderate rally as some coins become unavailable. Then, as ETF-related inflows begin, you could see a second wave of rapid upward pressure. Finally, as institutional liquidity corridors fill and adoption becomes tangible, the market could enter a multi-month phase of structural repricing, where XRP's price reflects not just speculation, but actual utility-driven scarcity. For holders, that's the sweet spot. Diamond hands through regulatory clarity, early adoption of DeFi projects, and patient accumulation could place you in a position to benefit disproportionately compared to newcomers who try to chase the move. Timing, patience, and understanding the structural flow of liquidity are key. Let's also consider one final angle: network effects. XRP's value isn't just in its coins. It's in the ledger, the network, and the participants. As liquidity corridors, wrapped projects, and institutional integration grow, network activity increases, and higher network activity tends to attract more institutional attention, which in turn removes more supply, which feeds the scarcity loop. Again, it's self-reinforcing. Scarcity drives adoption, which drives more scarcity, which drives higher perceived value. A feedback loop that can accelerate rapidly. So what does all this mean in plain terms? If XRP unfolds along this path, we're looking at a coin that isn't just moving because of hype or social media chatter. It's moving because the fundamentals of supply and demand are being redefined in real time. Exchanges have less. Retail has a limited slice. Institutions are poised to swoop in. DeFi is locking coins. Adoption is growing. The next 12 to 18 months could be transformative for holders who understand these dynamics. If you want a step-by-step breakdown of how to position, when to scale, and how to avoid the traps that wipe out 90% of investors, I put together something that will save you years of trial and error. The XRP Millionaire Blueprint. And inside, I lay out everything: the documents, the visuals, the timing strategies, the exact frameworks institutions are using. It's structured, it's clear, and it's built to help you stay 3 steps ahead.